we're talking all about active versus passive income sources. If you are trying to do any sort of real tax planning, it is essential that you understand the difference between active versus passive income. You do not want to miss today's episode. If it's your first time here, my name is John Boyd. I'm a certified financial planner, and I'm the founder and lead wealth advisor at Modern Wealth. That's Modern spelled with, you already know, no vowels, wealth. We're a fiduciary fee-only financial planning firm located in Scottsdale, Arizona, and we do it all from tax planning, travel concierge management, investment management, you name it. We're your one-stop shop, and we're happy to serve you and your family. We got a good one for you today, all about active versus passive income. The reason why I wanted to do this video is that there are a lot of misconceptions with this concept, right? It's one reason why you see, like on TikTok, people thinking that they can buy a vending machine and have the losses from a vending machine offset their W-2 income that they earn at their job, right? It's just a bunch of baloney 90% of the time. This is one reason why a lot of people think that real estate is the gateway to tax savings. While yes, real estate can be a really, really powerful tool, if you do not understand this concept, you are going to be disappointed. So I wanted to do a video on the concept of active versus passive income, because I think once you get your head around this concept, it will make just overall tax planning a little bit easier to digest. So let's go ahead and dive into some examples to break this all down. Before we dive into our example, if you need more in-depth help, we are still taking new clients. So again, visit us at www.modernwealth.com if you would like a free consultation so that we can learn more about your particular situation. So let's go ahead and dive into some examples. So I think the easiest way to think about passive versus active, when in doubt, if you are really not doing anything to earn that income, right? You're just kicking your feet up, relaxing, right? And earning that income. It is generally viewed as a passive income source. Great example of that. You go on your phone and you buy a stock that pays out dividends, and you sit back, relax, and just collect those dividends while you go live your life. Well, generally speaking, that is going to be considered a passive income source, and the taxation is going to be different than active income. Same with real estate, right? 95% of the time, when you have a passive rental property that is spitting off rental income to you, even though that you may be involved, screening out tenants and responding to calls and all that, the IRS generally views real estate as a passive investment. So with that being said, you can take a look here. Rental income, generally speaking, is going to be passive income. Dividends and interest, right, from your brokerage account, from a high yield savings account, whatever it is, those are generally going to be viewed as passive income sources. Capital gains transactions, generally speaking, right? So you buy an ETF or a stock, a couple of years later, you sell that thing. Generally speaking, the capital gains associated with that transaction are going to be considered passive. Now, when we think about active income sources, this is going to be obvious, right? W-2 income, the job that you're working 40 hours a week to get a paycheck from, that is obviously going to be an active income source. So W-2 income, the self-employment income that you're generating, that is going to be viewed as active income. Consulting work that you do, if you have a partnership, you and some partners in a particular business, and you're generating income from that, and you're actively participating in that business, that is generally going to be viewed as active income. So again, really, really important that you understand the difference between the two. Let's go ahead and use some examples. Let's say that you generated $25,000 worth of passive income. And just for this example, let's just say that $25,000, most of that derived from rental income. Let's also assume that you generated $100,000 in income, and let's just assume that the majority of that income was W-2 income. Okay, so $25,000 from passive income sources, most of that coming from a rental property that you have, and then $100,000 of income, most of that coming from the job that you work at. So let's say that your rental property, after you factored in just, marketing expenses, right? You putting that place up for rent and the costs associated with that, costs of repairs to the property, overall depreciation that you took, right? All that good stuff resulted in $35,000 in rental losses. Okay, so you had $35,000 in rental losses, $25,000 in rental income, which nets you out $10,000 in passive losses. Okay, now this is where people tend to get confused. Okay, this is really, really important to get your head around. Because most people, when they see this, right, they see, oh, I netted out $10,000 in passive losses. Well, that just means that I can go ahead and use the $10,000 in passive losses and offset the $100,000 in W-2 income that I had, right? That would mean that my overall income for this year is $90,000. Yippee, right? Sounds pretty good, right? That is incorrect. Just because you have $10,000 in passive losses does not mean that you get to just carry that on over to your active income to net that out, right? Effectively, think of it this way. The IRS really views them in their own lanes, right? If you have net passive losses, then you can go ahead and carry forward those losses to future tax years to offset other passive income that you have, right? But you can't just load up on passive losses to offset your active income or the income that you're earning from sources like W-2 income. Well, this is where, again, understanding the tax code, understanding how to play the game with real estate is really, really important because, again, there are ways, again, it takes a lot of planning and it does take work. There are ways that your rental income could be considered active income. And if it's considered active income, therefore, the losses that it generates would be considered active and would be able to negate your active income, right? It's not like it's impossible. There are, again, other exclusions such as the capital gains loss exclusion that you can use a small portion of capital gains loss to offset active income. But generally speaking, everything is kind of bottled up in their respective categories. So there you have it, guys. Those are the basics around passive versus active income. We will be building on this concept in other areas, right? We're going to do a series on the basics of rental property taxation. And if you are wanting to understand all of that, you need to understand this concept, right? Tax loss harvesting with stocks in a portfolio. You need to understand this concept in order to grasp some of the more elaborate, tax strategies in that world as well, right? A lot builds off of this concept. So I would encourage you, rewatch this video if you need to understand this, because a lot of tax strategies revolve around active versus passive income. If you need more help with your own tax planning, reach out to us at www.modernwealth.com. That's modern spelled with no vowels, wealth.com. I hope you have a great rest of your day, and we'll see you next time.